Good morning, good afternoon, or good evening, depending on what time you have decided to start Learning Module Number 1, Chapter 1. I will be presenting 3 learning modules. Each learning module will address each of the 3 financial statements that you'll be responsible for in this class. The income statement, the statement of retained earnings, or owner's equity, and the balance sheet. There is a 4th financial statement that we will not be doing in this class unless we have time at the end, because you get it in Accounting 220, and that is the statement of cash flows. So let us begin with the income statement. So now we are going to begin with the income statement. Most of the time, companies will ask this one simple question: how much money did we make? Or are we profitable? The income statement shows us if we are profitable. So what is the income statement and the terms that are associated with that? An income statement reports a company's revenues, like my new tool, and expenses. Revenues are an increase in resources resulting from the sale of goods or services. We talked about revenue the other day in class when I mentioned the revenue recognition principle as well as the matching principle. Remember that the revenue recognition principle is that revenue should be recorded when a resource has been earned. Better yet, it doesn't matter if you got cash for it or not. If you earned it, then you're going to record it. An expense is a decrease in resources resulting from the sale of goods and services. So revenues increase resources and expenses decrease resources. When we talk about resources, we're going to talk about assets, and we're going to talk about that here in a minute. But an asset is a resource of the company that has some future benefit. In addition to the revenue recognition principle, we have the matching principle, where expenses should be recorded in the period the resources are used to generate revenue. I gave the example of I'm paying sales commission to my salesman. He sold something that gave me revenue. I need to pay him. That is an expense. So the basic structure of the income statement is revenues minus expenses equals net income or a net loss. So therefore, if revenues exceed expenses, then you end up with net income. If expenses exceed revenue, you end up with a net loss. We like to show that over something we call a specific period of time. An example is for the year ended December 31. So we call that a specific period of time. There are 3 financial statements we'll be covering. 2 of them get reported at a specific period of time. Those are the income statement and statement of retained earnings. And then the balance sheet gets reported at a point in time. As of December 31 is a point in time. So before we begin, you're going to see a blank page here, and I'm sorry if there was a delay in the audio. I was trying to figure out if I got the right slide or not. And so let's go ahead and I'm going to take a look at example number 1. And it's actually, I'm going to have you all turn to page 17, number 1. Page 17, number 1. And the problem says, Ted's typing service generated $4,000 in revenue in the month of January. Salaries were $1,500 for the month, and supplies were $200. Additionally, Ted incurred $50 for advertising during the month. So let's go ahead and let's take a look at this particular exercise. So if we were building an income statement, we would do this. We'd go income statement, and I'm going to show you what an income statement looks like here in a minute, but I thought I'd do it this way to start. We'd have income statement, and it is for the, excuse the writing, for the period ending January 31, and let's just say it's 2014. We would then go ahead and show the revenues. Revenues and sales are interchangeable. So we would show revenue of $4,000. Okay. Then we said that we're going to go ahead and report the expenses. Whether they were paid or incurred, we go ahead and pick them up. So in this case, we have salaries of $1,500. We also have supplies of $200. And additionally, Ted incurred, remember the other two were paid or used, Ted incurred $50 for advertising, so we would include them. If they're incurred, they're paid, or they're used up, we're going to go ahead and include them. That gives us $50. So then if I go ahead and I total this up, I have total expenses. 1,500 plus 200 is 17 plus 50, 1750, gives me net income, because we said revenues minus expenses gives me net income. And so in this case, if we get a calculator out, we end up getting 4,000 minus 1,750 gives me 522. 2250 is our net income. Revenue minus expenses. Before we go on and I show you what the, let's go ahead and take a pause for a moment here. Let's go ahead and take a look at number 2 on page 17. And I'd like you to read through that problem, and I would like you to calculate the amount of the revenue the manager must generate to reach his goal. So effectively what we're going to take is what we see here on number 1, and we're going to work backwards to come up with the revenue, because we know revenue minus expenses equals net income. So why don't I give you guys a couple minutes to go ahead and take a look at that problem, read through it, and then go ahead and see if we can come up with an answer. I should be playing the Jeopardy music, but I won't do that. Okay, I think you probably have all had a chance. If not, you can certainly pause it and then come back. So now we're going to go ahead and review it and see how you did. So it said in number 2, the manager of a small company has a goal to generate $13,000 in net income, right? So if we just plug in what we just did here, $13,000, and he's confident that the expenses will be approximately $82,500. So we've been asked in this problem, how much revenue would we have to generate to get $13,000 of net income? And so if we're looking at this, I think I could just add these two together. So I'd get $95,500 would give me the revenue to make this net income if the expenses were this. So let's go ahead and go forward now and take a look at what a formal income. I had an extra item in there. I'll have to go back to that, I think, or use another page. So this is what an income statement example looks like. We have Lawn Service Inc. income statement for the month ending June 30th. We show revenues of $400. We show the expenses, and then we show net income. And that is what the statement looks like. So now let's go forward, and I have a blank slide. I was also going to go ahead and work another problem with you, another example. But right now, I'm going to kind of review or introduce some categories to you, or what goes on the different financial statements. So what we have is we have the income statement. What goes on the income statement is revenue. And then we have, I'm going to go ahead and call it some aliases. So some of the aliases, which that means it's also revenue, would be sales or services. Those would be considered revenue and would go on the income statement. Okay. In addition to that, we have expenses. And there's a whole list of expenses in the back of the book, I believe, I don't believe it has a page number, but it's also under my helpful hints. But in the back of the book, there's also a whole list of different kinds of expenses. And it's after page 388, so that would be 389 for me. And it says Comprehensive Chart of Accounts. If you take a look at that comprehensive chart of accounts in the back of your book, I'll let you all turn to it, it gives you the items that fall under each of the major categories that we use in building our financial statements. So 2 of the categories that go on the income statement are revenue and expenses. Anytime you see the word expense after it, with the exception of something that says prepaid in front of it, it's going to go on the income statement. So if you're looking at that page, you can see we have advertising expense, we have fuel expense, we have payroll tax expense or taxes expense, we have salaries, we have cost of goods sold, which is when we sell inventory. You'll learn that later on. We have rent. All of these are examples of expenses. Any of those that are given to you in a problem, like you will see here as we move forward in a moment, will go on the income statement. So that is what goes on the income statement, revenue and expenses. If we take a look at our next statement, which we'll be doing in Learning Module number 2, which is what we call the Statement of Retained Earnings. Sometimes this is also called the Statement of Owner's Equity. We use the Statement of Retained Earnings when we're talking about a corporation. We use the Statement of Owner's Equity when we're talking about anything other than a corporation, a partnership, or something we call a sole proprietorship, which is a mom and pop shop. What goes on the statement of retained earnings is beginning retained earnings, and I'm going to abbreviate, net income, dividends, all go on the statement of retained earnings. So if you see any of this verbiage in a problem, then you're going to know that it goes to the statement of retained earnings. The last statement that we're going to talk about is the balance sheet, and we're going to get into that in a little bit further detail in learning module number 3. But what goes on the balance sheet is a category called assets, liabilities, and owner's equity. Under each of these categories go accounts. Again, if we go back and we look at the comprehensive chart of accounts, you'll see under assets, you'll see cash, petty cash, accounts receivable, which is money owed to you when you have made a sale or service and they've not yet paid you. It would be accounts receivable. Inventory, prepaids, like prepaid rent or prepaid insurance. You also could have equipment, land, buildings, and let's just go down the list. Depreciation, goodwill, patents, supplies, notes receivable, office supplies. Those are all examples of assets. So anytime you see one of those, it's going to go on the balance sheet. Not on the income statement, but on the balance sheet. Now we'll go over to our next category, which are liabilities. And we're going to talk more about these in learning module number 3. There we have something we call accounts payable. I'm going to abbreviate. Dividends payable, income tax payable, sales tax payable. Anytime you see the word payable, it will always be a liability. Always. Then if we go down under owner's equity or equity, you'll see stock, retained earnings, dividends, and so forth. And so we're going to talk about that goes under here is retained earnings and then common stock, if that's applicable, as we move forward in these beginning building of our financial statements. So let's go forward. And we have a black page, which means it's time for another example. So let's go ahead and turn to page 21, number 25. Number 25. We are going to work this problem together, and then you will have an opportunity to do some Cengage exercises once we're done preparing the 3 financial statements in the 3 learning modules. You will then have an opportunity to go build these statements on your own, plus a couple of practice problems. So let's go ahead and look at number 25. It says, prepare the income statement for this particular year. It also says to prepare the statement of retained earnings for the year, but we're going to hold on to that and we're going to pick this up in the second learning module. So right now, let's just go ahead and let's not put any of the titles or anything. Let's just build the income statement. So we know we're always going to have revenue first. So if we pick up service revenue, and the dollar amount is $61,000. Okay? We're now going to look for expenses because we know it's revenue minus expenses. So we go down, if we just go down the list, we see advertising, and I am going to abbreviate advertising expense for $2,400. We see dividends paid. Dividends is not revenue. It is not an expense. It is something that goes on the statement of retained earnings. So we're not going to pick this up. We have rent expense, which is $10,400. We have retained earnings. Doesn't go on here. Remember, only revenues and expenses. Salaries expense, $28,000. Service revenue we picked up already. Utilities expense, and I always spell utilities wrong, for $1,800. So now what we're going to do is we're going to go ahead and add these up. So if we go ahead and take a minute, and you can do this as well there at home. I sound like one of those cooking shows. And if we go ahead and add this up, we just do this. So let's go ahead and find my calculator here on my cell phone. Okay, so 2,400, so check my math, plus 10,400, plus 28,000, plus 1,800, gives me 2,400 plus 10,400 plus 28,000. I'm going to double check the book to make sure it's 28,000 plus 1,800 gives me 42,000. So total expenses 42,000. Hey, watch this. This is pretty cool. I can erase. Okay, 42,600. So remember, revenue minus expenses gives me net income. So if I take the 42,000 from the 61,000, I end up with net income of $18,400. And that is how you go ahead and learn how to do an income statement. So let's see what else we have. So it looks like I've got a bunch of extra pages. Not sure why. I maybe use more of those. So with that, we're going to end learning module number 1. And you can go on to learning module number 2. But before you do, let's recap what we learned here in learning module number 1. Module number 1, we learned that the income statement shows the profitability of a company. The accounts that go on the income statement is revenue, which can be sales or services, minus expenses, examples, rent expense, salaries, gives us net income, and that's the abbreviation, net income. That shows the profitability of the company. For all the money that came in, and for all of the revenue that came in, and all the expenses we spent to make that revenue, we end up with net income. We also learned that there's another statement called the Statement of Retained Earnings, and on that we have retained earnings, net income, and dividends. And we'll see how they flow in the next learning module. And last, we came up and we showed what the balance sheet had on it. And the balance sheet has assets, liabilities, and owner's equity on them. Assets include accounts like cash, inventory, accounts receivable, equipment, building, land. Liabilities include accounts or categories called accounts payable, notes payable. Anything that is a payable would go under here. And then in owner's equity, we have retained earnings and capital stock that we'll talk about later. So until learning module number 2, keep this under your hat.